Have you ever scrutinized your current investment strategy? Could it be more efficient? Now, those are some questions worth pondering. Every savvy investor knows the significance of a good investment strategy. It's like a compass in the vast ocean of financial markets, guiding us towards our goals while navigating the waves of risk and return. But what if I told you there's a strategy that can help you strike a balance? A strategy that harmonizes risk and reward and is not skewed towards any one side. Yes, we're talking about the balanced investment strategy. It's not just a buzzword, but a well-structured approach that can potentially revolutionize your investment journey. It's about maintaining equilibrium, fostering stability, and ultimately achieving financial prosperity. If these questions are circling your mind, you're in the right place. Today, we'll unravel the essence of a balanced investment strategy. A balanced investment strategy is a method of portfolio management. Now let's break that down a bit. Imagine you're at a buffet. You wouldn't fill your plate with just one type of food, would you? No, you'd want a variety of dishes to satisfy your different cravings. Well, a balanced investment strategy is pretty much the same concept, but for your financial portfolio. Let's dive deeper into this. A balanced investment strategy involves diversifying your investments among different asset classes like stocks, bonds, and cash. This mix is crucial for achieving a balance between risk and reward. Think of stocks as the spicy dish at the buffet. They have the potential for high returns, but they also carry a higher risk. They're great for capital appreciation, which means they can increase in value over time, giving you a chance to sell them for a profit. But remember, with great potential comes great risk. On the other side of the spectrum, we have bonds. Consider them as the comfort food of your portfolio. They don't have the high return potential of stocks, but they're generally more stable and provide a steady stream of income. They're like receiving a reliable, smaller portion of dessert at regular intervals. And then there's cash, the bread and butter of your financial meal. Cash investments are the safest, but they offer the lowest returns. They're a good place to park your money when you're not sure where to invest or when you need to preserve your capital. By having a mix of these different asset classes, a balanced investment strategy aims to provide both income and capital appreciation while avoiding excessive risk. It's about not putting all your eggs in one basket, or in our buffet analogy, not filling your plate with just one type of food. So, a balanced investment strategy is about managing risks and rewards. It's about finding that sweet spot where you're comfortable with the level of risk and satisfied with the potential returns. Just like at the buffet, where you find the perfect balance of flavors to satisfy your palate. Now, implementing a balanced investment strategy isn't rocket science. Picture this: you're a chef and you're preparing a meal. You wouldn't just use one ingredient, would you? No, you'd use a variety of ingredients, each adding a unique flavor to the dish. The same principle applies when you're crafting your investment portfolio. The first step is understanding your risk tolerance and financial goals. Knowing how much risk you're comfortable with and what you're aiming for financially is like knowing what kind of meal you're preparing. Are you making a simple comfort food dish or a spicy, adventurous one? Once you have a clear understanding of your risk tolerance and goals, you can start adding the ingredients to your investment dish. These are the different asset classes you'll be investing in. Typically, a balanced portfolio includes a mix of stocks, bonds, and cash or cash equivalents. Stocks or equity investments are like the spices in your dish. They can add a lot of flavor or, in investment terms, potential for high returns. But they also come with a higher level of risk. Bonds, on the other hand, are like the staple ingredients in your meal. They're generally more stable and predictable than stocks, providing a steady flow of income. And cash or cash equivalents, they're like the salt in your dish. They don't add a lot of flavor on their own, but they're essential for balance. They provide stability and liquidity to your portfolio. Now, how much of each ingredient you add depends on your personal risk tolerance and goals. If you're a risk taker aiming for high returns, you might want a portfolio heavily seasoned with stocks. If you're more conservative, you might prefer a dish with more bonds and cash. But remember, just like in cooking, balance is crucial. That's where diversification comes in. Diversification is the process of spreading your investments across different asset classes and within those classes to reduce risk. It's like ensuring you have a variety of ingredients in your dish, so if one doesn't turn out as expected, the others can still make the dish delicious. After you've assembled your portfolio, don't just let it sit and simmer indefinitely. Regularly review and rebalance your portfolio to ensure it stays aligned with your risk tolerance and goals. This might mean adjusting the ingredients from time to time, selling off some investments and buying others to maintain the right balance. And finally, keep an eye on the cooking process. Monitor the performance of your investments and don't be afraid to make adjustments as needed. Remember, the financial market is not a set-it-and-forget-it oven. It's more like a stove where the heat can fluctuate and you need to adjust accordingly. To recap, creating a balanced investment strategy involves understanding your risk tolerance and goals, determining the right mix of assets, diversifying your investments, and regularly reviewing and rebalancing your portfolio. Remember, just like a chef with a recipe, you don't have to figure this all out on your own. There are many resources available, including financial advisors, to help guide you in creating a balanced investment strategy that suits your palate. With these steps, you can start creating a more balanced and effective investment strategy. You might ask, why should I consider a balanced investment strategy? Well, let's dive into that. First off, a balanced investment strategy offers effective risk management. By spreading your investments across a diverse range of asset classes, you're not putting all your eggs in one basket. It's like being at a buffet and having a bit of everything instead of just piling your plate with shrimp and hoping you don't get tired of it. When one sector or asset class isn't performing well, others might be thriving, helping to balance out potential losses. This can smoothen the ride and reduce the overall risk of your portfolio. Secondly, a balanced investment strategy can provide the potential for steady growth. While it may not deliver those rocket-to-the-moon returns that some riskier investments promise, it can offer a consistent and steady growth trajectory over the long term. Think of it as the tortoise in the race between the hare and the tortoise. Slow and steady can indeed win the race in the investment universe. Thirdly, and this is a big one, a balanced investment strategy is suitable for a wide range of investors. Whether you're a newbie dipping your toes into the investment pool, a seasoned investor looking to safeguard your portfolio, or somewhere in between, a balanced strategy can be tailored to your risk tolerance and financial goals. It's like a custom-made suit, cut and stitched to fit you perfectly. Lastly, let's not forget the peace of mind that comes with knowing you have a balanced, well-diversified portfolio. It's like having an umbrella on a rainy day or a flashlight in a power outage. It gives you that sense of security knowing you're prepared for different market conditions. So, whether you're looking to grow your wealth, protect your assets, or both, a balanced investment strategy can be a smart move. It's about finding the right mix of investments to achieve your financial goals while keeping risk in check. In essence, a balanced investment strategy can help you navigate the volatile world of investing with more confidence. Let's quickly revisit what we've learned today. A balanced investment strategy is an approach that combines a variety of different assets to achieve a balanced risk-reward ratio. It's like creating a financial symphony, each instrument playing its part to create a harmonious tune. To implement this strategy, start by defining your financial objectives and risk tolerance. Then diversify your portfolio by investing in a mix of stocks, bonds, and other assets. This strategy is not just about investing in different assets, but about finding the right balance based on your financial goals and risk tolerance. The benefits of a balanced investment strategy are far-reaching. It provides a safety net against market volatility and potential losses, while still offering opportunities for growth. It's a strategy that lets you sleep peacefully at night, knowing your investments are working hard for you. Remember, a balanced investment strategy isn't a one-size-fits-all solution. It's a tool to tailor your investments to your unique needs and goals. Happy investing.